It's a new month here at Henssler Financial, and we found three important things to focus on in the market this month. Number one, debt ceiling. With tax season coming to a close, recent federal tax receipt data points to the potential for the U.S. Treasury to run out of money by July without a raise to the debt ceiling. To fund government expenditures, the U.S. Treasury issues bonds, and once the debt limit is hit, the Treasury cannot legally issue more securities. This risks a default on U.S. debt, something that is yet to happen in history. A default would be anywhere from catastrophic to highly disruptive. However, more importantly, any deal would have significant implications for interest rates and fiscal spending. The recently passed Republican bill proposed a raise in the debt ceiling by $1.5 trillion, but future spending cuts of $4.8 trillion. Democrats balked at this plan. We will be watching if and how a deal is made, as lower future spending could lower future inflation and growth expectations, as well as interest rates. Number two, Q1 earnings. With over half of S&P 500 companies having reported earnings so far this quarter, the scorecard is mixed. While expectations were for a 6.7% decline in earnings, the blended earnings decline for the S&P 500 is 3.7%, with 79% of companies beating estimates. However, this is the second straight quarter of earnings declines. Analysts still expect earnings to decline in Q2 as well by less than 1%, but a turnaround is expected into the second half of the year. Earnings growth is expected at 1.7% in Q3 and 8.8% in Q4. Thus far, the slowdown in profits has been slower than expected, but it will be important for investors to begin to see gains later this year to justify the slightly elevated valuation on the market currently. Number three, recession odds. While the likelihood of a recession has been part of the conversation since late last year, economic reports have been relatively solid in the first part of 2023. Parsing through the data, the odds of a recession over the next 12 months range from 30 to 90%. The Conference Board sees near guaranteed odds, and the New York Fed's own Treasury spread indicator sees 58% odds. It seems like some sort of slowing is fairly well telegraphed. So, what is the market pricing in? Well, the bond market sees around 200 basis points of cuts into late 2024, which would be a mild recession, and the stock market seems to agree that a mild recession or soft landing is possible given earnings estimates and valuations. We think this is the crucial question to ask: mild or deep recession? And we will be looking at jobs data the rest of the year to help us decide what is more likely. A steep rise in unemployment could signal a need for more caution, while a steadier course could see a solid return to growth by late next year. And that's been your Market Minute for the month of May. Thanks for listening.